People are asking one big question right now. Why did silver suddenly crash when nothing looked wrong on the surface? Prices dropped fast. Fear spread even faster. And retail investors were left confused and angry. But here's the truth most people are not talking about. This silver crash was not random. It was not natural market behavior. It was triggered, forced, and accelerated by margin hikes and liquidations happening behind the scenes. And once you understand this, you will never look at silver markets the same way again. Welcome to Global Economy Insights, where we break down complex market moves into simple, clear stories anyone can understand. If you want honest explanations about global markets, commodities, and financial power games, make sure to like this video and subscribe to the channel right now. It really helps the channel grow, and it ensures you never miss important updates like this one. Now let's start from the beginning. Because the silver crash did not start with selling pressure from investors. It started with exchanges quietly raising margin requirements. Margin is the amount of money traders must keep in their accounts to hold futures positions. When margins are low, traders can control large positions with less cash. But when margins are suddenly raised, everything changes instantly. Imagine you are holding silver futures, and overnight the exchange tells you that you must add more money to keep your position open. If you have the cash, you survive. If you don't, your broker forces you to sell. This is not a choice. This is liquidation. And when thousands of traders are forced to sell at the same time, prices fall sharply, no matter how strong the fundamentals are. This is exactly what happened recently in the silver market. Exchanges raised margin requirements during a period of high volatility. That move created instant pressure. Many leveraged traders could not meet the new margin calls, so their positions were closed automatically. Selling flooded the market. Prices dropped fast. Panic followed. What makes this even more interesting is the timing. Physical silver demand remained strong. Premium stayed high. Long-term investors were not suddenly bearish on silver, but futures prices collapsed anyway. That tells us something very important. This crash was driven by market structure, not by real supply and demand. Big institutions understand this system very well. They know that when margins rise, weak hands are pushed out. Forced selling creates artificial price drops. And during that chaos, large players with deep pockets can step in and buy at lower prices. Retail traders, meanwhile, are left holding losses and confusion. This is not new. We have seen this pattern before in silver and gold markets. Whenever prices rise too fast, exchanges often respond with margin hikes instead of letting the market naturally adjust. Officially, they say it is to control volatility, but in reality, it often leads to sudden crashes that benefit those who are prepared. The most painful part is that margin hikes hit small traders the hardest. Big banks and hedge funds have capital. They can absorb margin increases easily. Retail traders usually cannot, so the system quietly transfers positions from small players to large ones, all under the label of risk management. As prices started falling, fear ticketing stop-loss orders were triggered. Algorithmic trading systems joined the selling. Momentum flipped from bullish to bearish in minutes. What started as margin pressure turned into a full-scale liquidation wave. Many people watching the charts thought silver was failing. They thought the story was over. But if you look deeper, nothing actually changed about silver's long-term role. Inflation concerns remain. Debt levels are rising. Currency trust is weakening. Industrial demand for silver continues to grow. Yet the price was pushed down by forced mechanics, not by reality. This is why understanding margin requirements is so important. Price charts alone do not tell the full story. Behind every sudden drop, there is often a mechanical trigger. Margin hikes are one of the most powerful tools exchanges have. With a single announcement, they can change market behavior overnight. Another key point many people miss is that paper silver and physical silver behave very differently during these events. Futures markets react instantly to margin pressure. Physical markets move slower. That is why we often see price crashes on screens, while physical premiums stay high or even rise. The disconnect confuses investors, but it also reveals how fragile paper pricing really is. When forced liquidations happen, emotion takes over. Social media fills with panic posts. Some people sell at the worst possible moment. Others swear they will never touch silver again. But experienced investors know that these moments often mark temporary bottoms, not long-term failures. This is where patience becomes a weapon. Markets are designed to test emotions. Margin hikes create stress. Liquidations create fear. And fear creates opportunity for those who stay calm and informed. At Global Economy Insights, our goal is not to tell you what to buy or sell. Our goal is to help you understand why markets move the way they do. When you understand the mechanics, you stop reacting emotionally. You start thinking strategically. If you've made it this far in the video, take a second to like it and share it with someone who is confused about the silver crash. It helps spread awareness, and it tells the algorithm that this content matters. Looking ahead, silver's story is far from over. Margin hikes can push prices down temporarily, but they do not erase structural problems in the global financial system. Debt does not disappear. Currency printing does not stop. Industrial demand does not vanish. These forces move slowly, but they move powerfully. Short-term pain often hides long-term signals. Force liquidations clean the market, remove leverage, and reset positioning. After that process, markets often stabilize and rebuild. The key is surviving the storm without making emotional decisions. So the next time you see silver crash suddenly, don't just ask why is the price falling. Ask what changed behind the scenes. Look at margin requirements. Look at liquidation data. Look at who benefits from the chaos. Because in markets, crashes are rarely accidents. They are usually engineered through rules that most people never read. Thank you for watching Global Economy Insights. If this explanation helped you, please like, share, and subscribe. Drop your thoughts in the comments below. Do you think margin hikes protect markets, or do they manipulate them? Let's talk.